Firms will be required to take steps to help customers repay their balances more quickly and to offer further assistance to those who can't. 3.3 million people are thought to be in persistent debt, costing customers an average £2.50 for every pound repaid. Among the moves being considered are the suspending of credit cards of struggling customers while they pay off their debt. Credit card companies could also reduce, waive or cancel interest or charges where a payment plan is still unaffordable. And customers who fail to cooperate or who can't afford a repayment plan should lose their credit cards.
So the rules we're proposing are that firms have to play a role now in helping people who are in persistent debt. What that means is that 18 months, after someone's been in persistent debt for 18 months, they're contacted by the firm, they're told about some of their options. As we go forward, if that continues for a further 18 months, then the firm has to put in a plan to make sure that those debts are affordable and repayable.
Peter Tutton is the head of policy at debt charity StepChange. Peter, is it too easy to get credit in this country?
It can be too easy to get credit. We've seen credit markets are growing very strongly at the moment. Credit standards have been falling. We've seen in the past how that can get people into difficulty. Our worry is we'll see that again. Credit cards are the biggest, most common debt that we see. About 2/3 of our clients have one or more credit card debts with an average balance of about £8,000. So it's quite easy, particularly with things like credit cards. We can get quite a big credit limit and quite very low minimum repayments for people to fall into difficulty over time.
Are there some issuers who are worse than others? I mean, for example, Royal Bank of Scotland 3 years ago did away with teaser rates, which was applauded at the time as being quite a good thing. Are there some people worse than others?
Well, I think we see sort of issues right across the market. So for us, the issue is about how we deal with problem debt, how we stop people falling into persistent credit card debt, and what's the best way to help people out of that. Now, lenders are capable of doing good things. We see good practice from all lenders, but also we see bad practice from all lenders. So there's something here about consistency. One of the things in the FCA proposals, they're saying firms need to do more to help. One of the things we would like the FCA to have said more about is how firms should help people. At the moment, it is left up to firms. They can do good things. They don't always do good things.
So you're broadly happy with what's been announced today?
Well, we think it's a start. There are some good things in there. Actually, we think the FCA should have gone further. This is about dealing with people who are in persistent credit card debt. Even after those remedies are in place, it seems that some people could still be paying their debts off, credit card debts off for 10 years or in some cases, 7 years at credit card rates of interest. So let's remember, these are products that are designed for short-term borrowing and are priced accordingly. They're quite expensive. If you use them for long-term borrowing, they get really expensive. So we think the FCA could have actually gone further and got firms to take action a bit quicker to help people to more affordable, more manageable borrowing.
Well, you said they could have gone further. I mean, your own charity's chairman is Sir Hector Sands, who used to run the FSA, which was the FCA's predecessor. He didn't do too much about this, did he?
Well, the FCA has started for a while. They're on a journey. They took over credit in 2014, so the old FSA didn't regulate credit in the way the FCA has done. They've done some good things. They've done some things on payday lending, and now they're turning attention to credit cards. They're going to have to turn their attention to overdrafts and other issues. They're not quite there yet. We hope they will get there. It's a question of drilling down into these problems slowly but steadily. As I say, what they've announced today is something that makes a difference, and the idea that firms can't just sit there and leave their customers in persistent debt while they rack in the profits. They've got to intervene and help people. But more to do to make that effective.
Where does personal responsibility come into all this, though, Peter? I mean, surely all these people that bite off more than they can chew, I mean, surely they shouldn't they just be tipped into bankruptcy and then live with the consequences in terms of having credit rationed to them in future?
Well, what we see, most of the people, or nearly all of the people we see, will be able to afford credit when they take it on. The problem is that when you take on more credit, your vulnerability to a change in circumstances increases. So there's something that lenders are much better at understanding people's vulnerability to debt than consumers are. People often say to us, well, I thought I could afford it because the bank told me I could. And it's that change in circumstances that often tips people over. Now, bankruptcy is a good solution for some people. What we know is when people are in financial difficulty, they need help with their debts. But for many people, the first port of call has to be help from their lender, and we hope that will get better from this.
All right, Peter.